When Warren Buffett buys or sells a stock, the entire financial world pays attention. It is not because he is always right, no investors, but because his moves are the result of a disciplined, time-tested strategy that has built one of the greatest fortunes in history. So, when the latest SEC filings from his company, Berkshire Hathaway, are released, it's like getting a peek at the playbook of a master. But simply copying his stock picks without understanding the why behind them is a dangerous game. You'll always be late, and you'll miss the entire point in this video. We're not just going to list the stocks Buffett is buying. We're going to decode the strategy behind those buys, analyze what they tell us about his current view of the market, and, most importantly, extract the timeless principles you can use to make smarter decisions in your own portfolio. This is about learning how to fish, not just being handed a fish. The first and most critical thing to understand is where this information comes from and its inherent limitation. Berkshire Hathaway is required by the U.S. Securities and Exchange Commission to file a document known as a 13F every quarter. This form discloses the company's U.S. stock holdings. It's a snapshot of the portfolio as of the end of the prior quarter. This is a crucial point. You are seeing what Buffett and his team were doing months ago. The stock price may have moved significantly since then. Therefore, treating this document as a hot stock tip list is a recipe for disappointment. Instead, view it as an educational tool. It's a case study in applied value investing. The real value isn't in the specific stocks, but in the patterns, the rationale, and the business logic that you can reverse engineer from these moves. It's about training your brain to think like a business owner, not a stock speculator. So, what overarching themes do we typically see in a classic Buffett purchase? He is famously looking for what he calls wonderful businesses at a fair price. This breaks down into several key traits. First, a durable competitive advantage, or an economic moat. This is a business that has some unassailable edge, a powerful brand, regulatory licensing, or low-cost production that protects it from competitors for a decade or more. Second, he looks for simple and understandable business models. Buffett has repeatedly stated he doesn't invest in technology he doesn't understand, which is why he was late to Apple. But once he grasped its ecosystem as a consumer products company, he made it Berkshire's largest holding. Third, he demands competent and trustworthy management. He invests in people as much as he invests in businesses. And fourth, he wants to see consistent earnings power and strong free cash flow, which allows a company to reinvest in itself, pay down debt, or return money to shareholders. When we analyze the latest filings, we look for changes that signal a shift in strategy or a conviction in a new idea, a new position. Even a small one is always noteworthy. It means Buffett's team of analysts has vetted a new company and found it worthy of the Berkshire portfolio. A large increase in an existing position is a strong signal of continued confidence, especially if the stock price has dipped, allowing them to buy more at a better price. Conversely, a trimmed or fully sold position tells a story too. It could mean the stock has become fully valued, the company's moat has eroded, or the outlook has dimmed. It's not just about the what, it's about the how much. The size of the bet is a direct reflection of Buffett's conviction level. $1 billion purchase for Berkshire is a significant statement. A small starter position might just be them dipping a toe in the water to learn more. Looking at recent history, one of the most dominant trends in Berkshire's portfolio has been a massive concentration in a few core holdings, often dubbed the Big Four or Big Five. This includes Apple, Bank of America, American Express, Coca-Cola, and Chevron or Kraft Heinz at various times. This concentration itself is a lesson. It reflects Buffett's belief that diversification is protection against ignorance, but that once you've found a handful of truly exceptional companies, you should bet big on them. His activity in the banking and financial sector is another area to watch. He has historically seen banks as a bet on the American economy itself, provided they are well-run and conservatively managed. His buys and sells in this space are a nuanced read on interest rates, the health of the consumer, and the regulatory environment. More recently, his increased focus on sectors like energy, with Chevron and Occidental Petroleum, signals a possible long-term thesis on energy security and inflation. Ultimately, the single biggest takeaway from studying Buffett's moves is not a specific stock, but a mindset. It's the discipline of extreme patience, the courage to be fearful when others are greedy and greedy when others are fearful, and the focus on the intrinsic value of a business rather than the daily gyrations of its stock price. Your goal should not be to mimic his portfolio, but to understand the principles that build it. What companies in your own life have a wide moat? Which ones do you trust and use every day? Start your research there, and then apply the same rigorous financial analysis we've discussed. Remember, this video is for educational purposes only. I am not a financial advisor, and this is not a recommendation to buy or sell any specific security. All investments carry risk, including the potential loss of principal. You must do your own due diligence or consult with a qualified professional before making any investment decisions. If you found this deep dive into the mind of Warren Buffett valuable, please hit the like button and subscribe to the channel for more analysis that makes you a smarter investor. Now, I'd love to hear from you. What's one investing principle from Warren Buffett that has most changed your approach to the market? Let's discuss in the comments below.